Okay, so basically, this is going to kind of bring up why we need to do these adjusting entries. Okay, so for the example of when you prepay an expense, like let's say we prepay insurance for a year, at the end of every month, we need to do something to basically account for the expense of insurance and also to make that asset go down. Okay, so at the end of every accounting period, we're going to have these adjusting entries to do things like interest. Okay, so you could have a very sophisticated accounting system that does this every day, right? Because technically, that prepaid insurance asset, every day it's going down. If you have a loan, interest is accruing every day, right? But the way that we're setting up our kind of system here is at the end of the month or the end of the quarter or the end of the year, whenever our accounting period ends, that's what we're going to do these adjusting entries. Okay, so this is not the only way to do it. I'm sure they're like in a mega company, like a large company, the accounting system is probably doing these accruals every day. Okay, but the way that we're going to learn it, just to learn the concept, is at the end of a period. So if we're doing a yearly financial statement, on December 31st, we're going to do all of these adjusting entries. Okay, they're all going to be dated on the last day of the period. So if it's a month end, it's going to be on the last day of the month. If it's a year end, it's going to be on the last day, December 31st. But the key thing to remember is that these are all going to happen on the last day of the period. So it's going to be for things like interest. Okay, so in this case, some time has passed, right? So we have to do an adjusting entry at the end of the month to kind of accrue this interest. If unearned revenue was earned during the period, right? We're going to have to do some adjusting entry to convert some of that liability into revenue. Prepaid insurance, another example, or any kind of prepaid expense. Time has passed, so we have to do something about that. Depreciation, okay? Time has passed and we've used up our assets like vehicles, machinery, all this stuff is been depleted. Okay, so we're gonna talk about what depreciation is in a second, but we also need to do an adjusting entry to kind of account for that expense. Okay, so these are just some examples of why we need adjusting entries to account for these types of things. So just the things to keep in mind about these adjusting entries. They're gonna actually change balances, okay? So they're gonna be just like any other journal entry in that if we did not include them, our financial statements would be different, okay? After we do these journal entries, it's gonna change the balances, right? Like for example, if we change unearned revenue, we said, hey, the person paid us, for 100 hours of work, but we did 30 of it, okay? We're gonna have some revenue that we recognize. So that's going to increase our revenue. So that's going to change our income statement. It's also going to reduce this liability. So that's going to change our balance sheet. Okay, so every time we make these journal entries, these adjusting entries, they're changing balances and it's going to alter our financial statements. So they're actually changing our accounting system. Okay, so you need to be clear about that. They will never involve cash because there's no actual transaction. Okay, it's just the passage of time or some other non-cash event has happened and you're accounting for that. So these adjusting entries that we do at the end of the period will never involve cash. And again, they're all dated on the last day of the period. Okay, so these are all kind of they're adjustments that we're making to account for certain things. Okay, so that's why they're called adjusting entries. Quickly, just like a terminology thing, I'm not going to dwell on this too long. Deferrals are things where the cash is exchanged before recognition. Accruals are things that are where the cash happens after. So we just talked a lot about these. Deferred expenses are things like prepaid expense, depreciation, inventory. So this is like the case of depreciation. We're buying the van and then we're depreciating it later, meaning the cash was exchanged earlier and then we're depreciating it later. Inventory, we buy the inventory now with cash, and then we expense it later when we sell the item. Okay, so these are deferred expenses. Deferred revenue, again, unearned revenue, where you receive the cash first and then you recognize the revenue later. And then it's just the opposite for accrued. So accrued expenses are interest, where you have interest payable and then maybe you make the payment months later. Salaries payable, and then you pay it off on payday. So again, these are when the cash is exchanged after uh, the, in this case, expense is recognized. And again, we had the same thing with the revenue, where you recognize the revenue and then the cash happens afterwards. Okay, so this is just a terminology thing, deferrals versus accruals.